What you've been told about stock market risk is wrong. How you've been managing stock market risk is also likely wrong. Now, I'm going to explain this, but if you want to learn more, you can check out my book, Evidence-Based Investing. It's available on Amazon, and you can do a little preview on my personal website, theodorehicks.com. So let me explain what I mean. If you've ever met with a financial advisor, or even if you've just set up a 401k through your employer, you're likely familiar with the question, what is your risk tolerance? Well, the question stems from an old theory, and I won't get into it here, but the theory is that bonds have less risk than stocks. And while that can be true, that is not always true. So ultimately, that theory is baked in a half-truth. The reality is that you can lose money in both stocks and bonds. And this is our first principle, that we define risk as the possibility of losing money. Ultimately, it doesn't matter if you lose money because your stocks went down or your bonds went down. Either way, you lost money or your portfolio value went down. Let me give you an example. On the screen, I've got 5 different equity-based ETFs. This is in 2022, and you can see it was a very bad year for stocks. But let's take a look at some bonds. Now we have a handful of bond ETFs also for the year 2022. So if you were allocated to stocks and bonds, did your risk tolerance really matter? You lost money on both sides of a traditionally allocated portfolio. So we need to return to the original question. What is your risk tolerance? Well, why is that question always asked? Because this is how risk is usually managed. So on the screen, I've got 4 overly simplistic portfolios broken down by how much is allocated to a bond, how much is allocated to stocks, and then how much is allocated to cash. Now, this strategy of a traditionally diversified portfolio, this strategy can work. But as I showed you in 2022, it certainly didn't. And this goes to our second principle, that there's no such thing as an investment strategy that works in every climate, every time. So there's one more principle that I'd like to explain briefly before I show you how we believe risk should be managed. So we have the data on the Dow Jones Industrial Average all the way back to 1900, and it's very easy for us to show you that the stock market does absolutely have prolonged periods of negative environments. The stock market has been in a negative environment for a long period of time, many times throughout our nation's history. So the third principle then is that we have no way of knowing the future. Stock market corrections can start at any time, and we have no way of knowing in advance if they're going to be shallow and short or deep and long. So returning to how risk is traditionally managed by allocating a certain amount of a portfolio to stocks and bonds as defined by your quote-unquote risk tolerance, that's how it's typically handled. This is how we typically manage risk for a client. Now, this is our moderate model. And you can see that we've got 2 different tactical strategies and we have 2 different quant strategies. I'm not going to explain them here. I explained it in another video. But effectively, there's 4 different equity-based strategies in this model. Now, each one of those strategies have different rules that guide our decision making. Now, as a simple example, this is our VSI. Now, again, I'm not going to explain this in depth here because I explained it in another video. But in short, imagine only investing in one of the green candles. It's not that simple, but that's the general idea. So how does this relate to how we manage risk in a client's portfolio? Well, instead of having a static allocation to stocks and bonds, because we know that there are absolutely time periods where both stocks and bonds go in a negative direction, instead, this is how we would handle risk. As our risk indicators change, we simply increase the amount of cash that exists in a portfolio. So in conclusion, we do not believe it is appropriate for you to reduce your exposure to equities just because you've reached some arbitrary age or because you're getting closer to retirement. We believe it is more appropriate to actively manage a portfolio and actively manage your exposure to risk based upon the realities, based upon the evidence that is prevalent in the stock and bond markets. If you want to learn more about our approach and this philosophy in general, feel free to pick up a copy of my book, Evidence-Based Investing. Thanks for watching. If you have any questions, by all means, feel free to reach out.